So from an individual's perspective, we're obviously looking to make sure that the company or the funds have done all of the due diligence, they've gone through the process, they've made sure that they're eligible. There are a number of stages to that. It's important that when you invest that you consider that first, so you don't just look at the tax money, the relief that you're potentially getting. You look at making sure the company's done what it needs to do, and obviously the guys from the fund managers will go through some of the conditions that they go through to make sure that that's the case. What we find typically is a lot of people, individual investors, don't consider that properly and don't consider that holding period, that 3-year period afterwards, and the consequences thereof. This is an opportunity, like we said, and you need to make sure that it's aligned with your overall strategy, so your tax planning strategy, whether that's your wealth planning strategy, your estate planning strategy for inheritance, or whether it's just your income strategy for the next few years. These reliefs, so these are the headline numbers that come in. Some of the things that aren't in here, which you need to take account of, is this income tax carryback period, so working with your accountant to make sure that actually you take the relief in the right period from your tax return point of view. Looking at the limits that you actually have to take into account when you're investing, so there are company limits and individual limits in terms of maximum investments. There's an increase in the EIS investment limit in relation to knowledge intensive companies as well, which is potentially given the opportunity to invest bigger and further amounts in those companies. And then, as I say, the capital gains tax planning point here, so the exemption, so the reinvestment opportunity, and also the loss relief that is available on income and on capital gains tax if things don't go according to